Did you ever wonder if earning money in your sleep is possible? Well, I am here to tell you that it is. How nice would it be to earn money outside of your day job? I am sure that earning money in this way would be truly life-changing. But how would you go about finding an investment vehicle that could achieve these results? Well, the answer is real estate. Stay tuned to the end of this video to learn how to make 50% on your money in 1 year alone. When you think of earning passive income, I bet what comes to mind is an investment, where once you make it then no further effort is needed to keep that investment going. If that is your definition, then passive income doesn't really exist. There are actually varying degrees of passive income. Each investment that you make has a different level of being passive than another investment that you would have in your portfolio. You might think of this as obvious, but choosing an investment while also taking into consideration the time needed to manage that investment is an important consideration. Since time is the one thing in life that we cannot get back, then this is the most important thing to consider when making any investment. When looking at real estate, if purchased properly and a qualified property manager can be found, single-family home real estate can be as passive an investment as they come. Now that the stage is set, let's get into the 5 reasons that real estate investing should be a part of your investment portfolio and how you can make a 50% return in your first year alone. Number 1 is cash flow. This is the amount of money that you make above and beyond the expenses and mortgage that you pay on your investment property. There are many expenses that you have to take into account when looking at the expenses for a single-family home. Some of them include the mortgage, property taxes, interest on the mortgage, management fee, and any repairs that may be required for that month. You will also want to set money aside for vacancy and capital expenditures each month as well. These things undoubtedly will happen sometime in the future. The goal is always to find a house where rents will surpass the expenses on a property and leave a little left over to pay you after these expenses are taken into consideration. The better you are at analyzing properties and seeing things that other investors don't see, the better your returns could be. On a 100K investment property, it is not unlikely to find a deal where you can make a 9% return on your investment. An example of what this would look like in real life would be that you could realistically expect to make $150 per month from your $100,000 investment property. Over the course of 12 months, this adds up to $1,800. If you divide that into your 20% down investment of $20,000, you end up with your 9% return. This is not too bad of a return on its own, but this single-family investment also earns a return in 4 other ways. Number 2 is appreciation. Appreciation is not something you should make your investment decision on alone, but it is icing on the cake. Throughout most of history, housing has continued to increase in value. Of course, this is not guaranteed, but it is probable. Even if there is a slight market correction and home prices go down, if you hold the property for long enough, then home values will surpass their previous property value high. The average appreciation rate is somewhere between 3 and 5%. For the example we will be using, we will be assuming a 5% appreciation rate. The investment property that you bought for $100,000 may appreciate to $105,000 the first year that you own it. That is a 5% appreciation rate. But wait, you have a mortgage on that property which provides leverage. If you put 20% down, you only put $20,000 down in order to purchase the property, the bank put in the other $80,000. You are levered at a 5-to-1 ratio. So if you take your 5% return and multiply it by 5, your real return on your money is 25%. Number 3 is principal paydown. Each time that you make a payment, a certain amount of that payment goes towards paying down the mortgage. In the beginning of a loan, this amount is pretty small and continues to get larger the further into your loan that you get. Since your tenant is paying you rent and you are using that rent to pay all of your expenses, your tenant is in essence paying your mortgage for you. Pretty cool, huh? With your $100,000 investment property and your first year you would have paid down a small amount of $1,800. Sounds like a small amount of money until you compare it to the amount of money that you have invested in the property. When you divide that into your initial investment, you come to a return of 9% from principal paydown. What that looks like is this: if you add up the total amount of principal paydown for 1 year, you come up with $1,800. When you divide that $1,800 into your initial investment of $20,000, then you come to your return from principal paydown of 9%. Number 4 is tax savings. Taxes can get a little complicated since everyone's tax situation is different. The key here is that the deductions you get from owning rental property offset the income that you are making from the investment. You get to deduct things such as depreciation, interest expense, maintenance, and repair items. Be sure to check with your accountant for your exact tax situation. Because of these deductions, after the math is calculated, you are likely not paying any tax on the cash flow that you are getting from your single-family home investment. Since everyone's tax situation is different, the return on your tax savings will be a little hard to calculate, but still will amount to a significant amount of savings. For this reason, we are going to assume a fairly conservative return of 5% return from the category of tax savings. Number 5 is inflation hedging. Paying your mortgage on your investment property in the future will be much easier than paying it now. That is because the value of the dollar goes down over time. It loses its purchasing power every single year. For the person holding cash, this is something that is terrible and is destroying your wealth. For those who own single-family investment properties, this is not such a bad thing. As inflation happens yearly, rents increase each year as well. However, your mortgage payment remains the same. This means that your largest expense of your property, your mortgage, is fixed over a 30-year time period, but your rents continue to go up each year. This means more and more cash flow each year that you hold the property. Inflation hedging is another category that is rather hard to measure, so we will conservatively call this a 2% return. If we add all of these returns up, cash flow 9%, appreciation 25%, principal paydown 9%, return from taxes 5%, and inflation hedge 2%, then you come up with a total return in year 1 of 50%. For these 5 reasons, you should make investment real estate part of your overall investment strategy today. If you have liked this video, hit the like button so more people will see this content, and don't forget to visit the Investor in You channel for more helpful videos such as this one.